Mr. Tipp, if this is the bond route, then I imagine it's welcomed because it's not much of a route, is it?
Well, it's not much of a route, but I think this is going to be a jagged period. The first quarter here, as you're hearing the whole run through the news run, there's a lot thrown at the market here. The BOJ taper, the ECB process going on there.
Yeah.
Inflation numbers are going to be up a little bit here with the commodity prices up, and you're going to get your first Fed meeting where there's likely to be a hike. And so the market's going to be, struggling to, find its level here.
Jason, it's been whippy over the last 24 hours. China backing away from that report just yesterday on what they may or may not do with their treasury holdings. That pushed a bit into treasuries. Then yields went up on the ECB account. Yields down on PPI. It comes in soft. The bottom line is when yields backed up, the bid that went into that auction yesterday for 10-year treasuries was strong. We're going to see more and more of that, aren't we?
Probably will, although in my opinion, I wouldn't overthink it. I remain bearish on bonds. I would remain bearish because I think the tax cut that was just passed is going to be meaningfully stimulative. And I think you're seeing there's demonstrable evidence of that this morning, whether it's Walmart or Waste Management yesterday. And if you look at the 2003 tax cut, 10-year treasuries went from 3.10 to 4.6% in 6 weeks after it was passed. And this is a much bigger tax cut. So there's no question there's a demand for yield out there. By the same token, I wouldn't get too cute in terms of, unless you're a trader, I wouldn't get too cute.
But this is a different backdrop to 15 years ago. The backdrop being that the ECB has a massive balance sheet, the Fed still has a massive balance sheet, the BOJ has a massive balance sheet,
and they all want to. And they all want to cut. And they all want to cut.
Maybe, but you'd imagine the stock effect of those balance sheets is still going to be pretty powerful, Jason.
No, I agree, and I'm not saying yields are going to go back to 4, but by the same token, I agree with Mr. Rosenberg of BlackRock that you have a situation where 10-year Treasury yields are meaningfully below nominal GDP growth and have been that way for a long period of time.
Yeah.
It seems to me the Fed is poised to take its thumb off the scale, and it's poised to stop essentially manipulating the most important price in the world, which is a 10-year Treasury. And that's, to me, a meaningful change.